We're going to wrap up Module 1 in this final section by linking integrated logistics models with the 4 objectives that we've talked about so often thus far, going into some detail about each. You will note that the 4 objectives that were originally presented as goals of supply chain are now being presented within the framework of integrated logistics. Why is that? Because there has to be consistency between supply chain as an overarching business activity and logistics, integrated logistics, as an individual business discipline. They're not the same thing. We've said that many times. Logistics is a subset of supply chain, but they must be consistent with one another, helping to transcend both internal and external activities. We need to be thinking about logistics activities that integrate and synchronize the buy side and sell side of our supply chain in a way to maximize revenue and profits. That's the title of the slide, Maximizing Sales Opportunities. In essence, based on the 10 rights of integrated logistics. We're going to list those in just a second. Right product, right place, right time, on and on. While doing that, we have to have a balance between increasing sales, the costs that we incur while generating those sales, and inventory levels. If this all sounds very familiar, it's because it should be. At the end of the last section, we showed the balance between sales and profits and investment in inventory, the costs associated with engaging in those activities, and the balance ultimately that has to exist between the income statement, the balance sheet, and cash flow from operating activities. We're taking that discussion to an objective, specific level, in this case, maximizing sales. As a quick example of our last bullet point, the cost of converting ocean shipments to air freight in order to not lose sales. That is certainly dynamic inventory management, and usually when importers are bringing in air freight, when they normally use ocean freight, it's because there is an imbalance between customer demand and available inventory. Needless to say, air freight is way more expensive than ocean freight, and sometimes, even though we as an importer can meet a customer's demands, we might end up losing money because the air freight is so expensive. So that balance between sales, inventory, and costs, really quite important. This is just one example. We mentioned the 10 rights of importing just a moment ago. How do they really relate to the maximization of sales opportunities within an integrated logistics program? And you will note that much of what we'll talk about now actually lines up with the whole 7P 2T methodology that we've also spoken of. The first one being the most obvious, product. That was the first P in the 7 Ps. So we need the right product. Definition, the product that the customer wants and is willing to pay a certain price for. But we need it in the right place, whether it's in a fulfillment house for online purchase in Dallas, Texas, or at a store in Portland, Maine. Has to be there at the right time. Lots of importers in the U.S. deal with things like seasonality, whether it's back to school, holidays, towards the end of the year, and other examples of seasonality. The product has to be at the right place at the right time. Next bullet point, right quantity. We not only have to have the right product, what the customer wants, but the right SKU, stock keeping unit, which is to say, does the product come in a pack of a dozen? Does it come as a single? Might it be by the thousands that a customer wants to buy? Have to have the right quantity and in the right condition. This is closely related to the physical world of logistics and getting goods to the right place, right time, etc., but in an undamaged fashion. And in traditional models, retail stores, that's hard enough. In an e-commerce environment where goods are being tossed around and sometimes even banged around, the potential for damage is that much higher. So the right condition, starting coming from a vendor overseas all the way to a customer's front door in Atlanta, Georgia, that's not easy to do. We can't maximize our sales opportunities if we don't get products in the right condition to customers. One of the more familiar rights is right price. That's the second bullet. But from our perspective as an importer, how about the right cost? Because the difference between cost and price, the price to the customer, cost to us, is the profit. So selling goods is one thing. Making money on the sale of those goods is another story entirely. And that's all tied into landed cost, the difference between landed cost and unit cost, what those real dollar amounts are, and how we can utilize logistics to drive down landed costs and be able to use ocean freight as opposed to constantly having to convert to air freight due to inventory imbalances. From our perspective as an importer, we need the right visibility. What's the status of a purchase order on a supplier in London, England? Where on the ocean from China to Seattle is the ship that is carrying 10 of our containers? What is the status of a customs clearance on a hot shipment that we need to get our hands on? Out into the customer distribution environment, we need the right delivery, be it to a store, to a factory, or certainly for e-commerce home delivery, B2C, business to consumer. The timing of that delivery, as well as the quality of the delivery itself, and the comportment of the people doing the delivery. That becomes really difficult when working with third parties that are doing last mile deliveries. In the end, it all adds up to the right customer service. We need to be thinking about the 10 rights as we endeavor to maximize our sales opportunities. Second up, landed cost controls. We all know, or at least we should by now, there is a big difference between unit cost and the landed cost of a product. It is very surprising to learn that many importers don't know the true landed cost of the goods that they import. An understanding of that landed cost on a per item basis starts with an understanding of what landed cost is in the first place. We'll talk more about landed cost later, but for now, quick definition: the unit cost is what you pay for an item at the factory door in Mumbai, India. Landed cost is a prorated expression of inland freight at origin, ocean freight transportation, customs clearance, customs duties, merchandise processing fee, harbor maintenance fee, inland freight, all of the cost expressed on a per item basis up to where you need to get the goods so customers can buy them. Third point, as it relates to the income statement, landed cost has a direct impact on gross profit and gross margin. Why is that? Because landed cost normally, not always, but normally from an accounting perspective, is embedded in cost of goods sold on the income statement. So the sales price that we sell a good for minus cost of goods sold, that's our gross profit. Gross margin, same idea, but let's just clarify something. Gross profit is always a dollar amount. Our gross profit on item ABC123 was $10. Gross margin is a percentage. You're never going to say, at least technically from an accounting perspective, you shouldn't ever say my gross margin was $10. No, it might have been 10%, but a margin is always a percentage. That's just a little pet peeve, but it's an important distinction. Bottom line, it is impossible to budget for expenses and margin without accurate landed cost. How are we supposed to know, as an importer, how to price our goods out to a customer if we don't know what it cost us? How are we supposed to budget, plan for the results of income statements on a monthly basis if we don't know the true landed cost? So important. But companies either ignore it, as hard as it is to believe, or don't understand it, or don't calculate it properly. We have numerous sections on how to calculate landed costs with lots of examples. Don't worry about that just yet. Here's a supply chain perspective, another example of the tools that we spoke of earlier, calculating landed costs. Let's jump in. The ability of an importer to calculate item-specific landed cost is important for a bunch of reasons, some of which we've already spoken of. First, if an importer doesn't know an item's landed cost, difficult to put a sales price on it, and as such, virtually impossible to determine the true gross profit of the product. That echoes what we just said. Also, since landed costs usually are included in cost of goods sold, which we already said, on an income statement, total gross profit and gross margin are likely to be incorrect. And there are lots of companies out there whose accounting is a little fouled up for just that reason. For U.S. importers, the expenses that make up landed cost include, to summarize what we've been talking about, the cost of the product itself, the unit price, transportation and related service charges, customs clearance and duties, as well as MPF, merchandise processing fee, and harbor maintenance fee here in the United States. One of the more complicated aspects of determining landed cost involves the assignment of expenses like transportation to specific items on a prorated basis. What does that mean? Well, think of an ocean container coming in. Let's go something simple like Yantian to Long Beach. Might have 4 or 5 different purchase orders in that container, goods that were originally under 4 or 5 different purchase orders. And there could be 30 or 40 items, all of which have a different unit cost, all of which have a different customs classification, all of which might have different packaging configurations, meaning one carton is bigger than another, more voluminous than another. The master pack quantities could be different. So how do you take the expense of, say, pick a number, $1,500 for a 45-foot container from Yantian to Long Beach with all these different items in it and assign the cost to each item? That's the trick. Prorating for landed cost purposes. We're going to show you how to do that further down the road. Lead time rationalization. Cumulative lead time, let's define it again. Simply stated, and this is an APICS definition, the American Production and Inventory Control Society, all of the time that transpires from the moment a product need is recognized until that need is fulfilled. Essentially, for supply chain execution purposes, planning for a year or less, it's from the time a PO is issued until the goods are received and ready to be sold. Cumulative lead time calculations must be conducted for every product in a company's portfolio. Now, maybe we're lucky as an importer and we buy a lot of the same stuff from the same vendor. That makes it a little bit easier. But the more vendors that we use in different geographic locations and the more items that we carry, the more complex that becomes. We need to know cumulative lead time for every single one. No way around it. Super important. Stability is as important as reducing lead times, what's referred to as lead time variation. We not only want to reduce lead times, but if we ship from Yantian to Long Beach 300 or 400 times a year, we want that lead time port to port to be 13 days as often as possible. We don't want it to be 13 days this week, 20 days the next week, 22 days the next. There's too much instability, too much variation. That has a damaging effect on inbound supply chains. We want to focus on, sure, reducing lead times, but making them stable. Why? Because there's a direct correlation between lead times, forecast accuracy, inventory levels, and safety stock. Bottom line, and we get into this in upcoming modules, the more instability there is in a supply chain, whether it's lead time related or anything else related, the more unpredictable things become, and the more the human element of buying early and buying often takes place. Call it padding, call it safety stock, call it buying before you should, because you don't trust the lead time as a buyer. Call it anything you like. The greater the variation in a supply chain, the worse inventory levels become. Here's a supply chain perspective that allows us to focus in on the impact of lead time variation, some of which we've already discussed. Many importers correctly focus on reducing cumulative lead times. That's a given. Why? Because longer lead times impact inventory management in a number of ways, extending the length of minimum forecast periods and adversely impacting functional activities like lead time offsetting during material requirements planning. As a programming note, if you're not familiar with this terminology in the first paragraph or what it is we're talking about, don't worry. We cover it further down the road. Take our word for it that what we're telling you now is true. The greater the variation in lead time, the bigger problems we're going to have in our supply chain management activities, especially as it relates to bloated inventories. While reducing cumulative lead time is an important objective, reducing variation is of equal, if not greater, importance. We want to reduce lead times, but we want to eliminate, to the extent that we can, variation. Yantian to Long Beach, ideally port to port, 13 days. But week 1, it's 13 days. Week 2, there's a storm on the Pacific, and the lead time turns into 18 days. The week after that, there's port congestion in Long Beach, can't offload the ship, it's 21 days. That level of variation creates some real troubles because Lead time variation is tantamount to uncertainty, which often compels purchasing agents, buying people, to place orders on vendors earlier than needed and in greater quantities. There's lots of causes for variation in cumulative lead times, but here let's throw out a few, like late production by vendors, product quality issues, goods being delivered to vendors at origin without commercial documentation. That's always a famous one. Rolled containers by ocean carriers, where a booking is made and then the carrier doesn't load the container. Non-compliance with importer security filing 10+2. And the other famous one, U.S. Customs clearance delays due to faulty or missing documents. For now, let's just agree, or at least take our word for it, that variation in any form in a supply chain is not good. Much of what we'll do in our training is to provide techniques to reduce variation. Inventory optimization, starting to wrap things up a bit here. Making the most of our dollar investment in inventory. Maximize sales without running out of inventory. Maximize sales without ending up with too much inventory. It's about creating a balance between profitable sales and inventory investment. Seeking a middle ground between stockouts and product saturation. Globally, this is very much related to the integration of buy-side and sell-side activities. We've already said a bunch of times, supply chain is about balancing supply with demand. Stable logistics programs can help drive down inventory levels without sacrificing sales, because stable logistics programs focus on things like reducing variation in lead times, like coordinating with vendors so they do have their documentation on time, like making sure customs entries are done 5 days out of port for an ocean shipment. There are many, many links between these objectives and what we can do in an integrated logistics model, both internally at the organization, at our company, and externally with third-party partners. Well, that's it for Module 1. We said that we would look at the objectives at the front end of every module and at the tail end, because in the end, your time is what's most important. The investment that you make in this training has to produce results. Only you can judge. What did we set out to do? Establish the strategic foundation of our import program, our import training program, present and analyze different inbound supply chain models upon which we will elaborate ad nauseum moving forward. We wanted to introduce the concept of integrated logistics to U.S. import supply chain management and demonstrate how those 4 objectives are equally important to logistics as they are to overall supply chain. And then finally, link import supply chain performance to financial outcomes. More on that later as well. That is the end of this module. We hope that you continue with your studies.